This is the New York Fire Department Pension Fund Investment Meeting. Today is 6/17/2015. It's now about 4 minutes after 10 o'clock. We're in the New York City Controller's Office, 1 Center Street, room 1117, New York, New York. We have a roll call of trustees, Lee.
Roll call of trustees. Mr. John Adler.
Present.
Ms. Suzanne Heinecker.
Here.
Mr. Antonio Rodriguez. Mr. Steve Cassidy.
John Kelly has Steve Cassidy proxy.
Mr. James Levin.
I have James Levin's proxy also. John Kelly has James Levin's proxy also.
Mr. Addie Brown.
Vincent Speciale, proxy for Eddie Brown.
Mr. John Kelly.
Present.
Mr. James McGowan.
Here.
Mr. John Farina.
Yep.
Mr. Paul Farrow.
Here.
Mr. Thomas Phillip.
Here.
Commissioner Douglas White.
Here.
We have 24 votes in the quorum. We may start the meeting.
Okay, thanks very much. I'm sorry, Doug. Did you
No, go ahead.
say something? Okay. First of all, I apologize about the cramped quarters here for a quarterly meeting. We get a lot to get.
Look, John's got all the room.
I would assume we have a number of interns. Is that it?
We do have some interns here. Will you guys raise your hands? We have a number of interns from the Controller's Office. It's great to see young people spending their internship in public service, and I had the pleasure of talking to them yesterday during lunch hour, and it's really an inspiring group of people. So, okay, so we got a lot to get through. It's a quarterly meeting time, and I have a little special report for you. But let's start with the regular stuff. If we turn to the quarterly book, the spiral-bound book. Page 12, I think it's the best place to start. We can look at what happened during the quarter. 239 basis points, 2.39%, which was 28 short of the policy index return. That was roughly split between allocation effect and selection effect. If you want to look at...
I was seeing what page you were on.
Okay, that was page 12. And then to look at the breakdown of the allocation and sector selection, you look at page 15, you can see that most of the allocation effect came from being overweight cash. The cash is actually a 2-year paper. The allocation effect clocks it as 90-day paper, so it overstates it a bit. And most of the selection effect can be found in developed equity, private equity, et cetera, with some overperformance or outperformance in hedge funds and a little underperformance in opportunistic fixed income. This is relative to benchmark, gross of fees for public markets and net of fees for private.
Scott, could you go back? You were saying that back to the allocation effect, saying that the cash is kind of, I guess, within our report seen as 90-day paper instead of the 2-year.
Yeah, I think so. I've got a group drilling into this because the split down of allocation effect and sector effect is looking a little funky to me. It is right that if you put the two together, the market was up 2.6%. And any type of fixed income was with a short duration was pretty flat, pretty close to zero. But how you break it down between allocation and selection effect depends on the benchmark that you're using. And so the benchmark, I believe the benchmark that they use is a 90-day, but it's unclear from the documents. I've asked the question. Hopefully by the next meeting I can give you a more detailed response. But it's made me question whether we, because the way we hold cash, and we have a very broad definition of cash, we may want to look into that and see if we could use a little finer tuning in the way that we do that.
All right, thank you.
So if you go to page 16, you see how we're doing relative to the Tux universe. You can see the benchmark was itself a very, very tough bogey during the quarter. It was in the 14th percentile, top 14%. the system was actually in the 40th percentile, a little above average, and you can see that the long-term numbers are about the same, a little better, but the benchmark is a very, very tough bogey. Now, a couple of weeks ago, we had been talking very broadly about the fact that we really needed to look at expenses returns net of fees in all asset classes, and that we had not been doing that historically. We had a broad brush estimate of the impact over the past 10 years, and we promised you that by the June data, which would have been in September, that we would formally incorporate net of fees performance into our reports, and we're on track to do that. And as evidence of that, I have just handed out to you the first quarter results looking at net of fees for the public markets. That was the missing piece. Now we just talked about 2.39. We go to the first page, the second column over. You can see that 239 up at the top, but that is gross of estimated investment fees across the public asset classes of 4 basis points during that 3-month period, and it would have brought the numbers down to 235. Which would have drawn the comparison from 28 basis point drag to a 32 basis point drag. And if you go out, you can see the results for the fiscal year to date and then the 1 year. We're running at a 16 basis point run rate for total public market expenses. Remember, this is just the public market expenses. The private are already net of fees. So what we have behind this, and we don't have it for the longer periods going back because it becomes very complicated to go back when we had different custodians. We're doing our best to build that information back historically, but we know we're going to be able to track it going forward. So the number you get, for instance, with the 3-year, you can see is just the same old number we were using before, which is the gross of public market fees, and that's a 3 basis point drag. So you can, if the fees were consistent through that period of time, it's about a 16 basis point drag on an annual basis, and these numbers are all annualized. So it just gives you a sense. Now, what we really want to do is to be able to drill down, and behind this you have a stock State Street report. We did not ask them to customize because we wanted to get your input, and it would have gone through all kinds of extra rigmarole with them to get a customized report, and we just wanted the data fast so we could get it in your hands and have you have a chance to look at it. So I'm not expecting an immediate turnaround here, but if you could look at these reports and see, how would you like the data differently? Any difference from what we've got here is going to be custom work. For instance, one of the things we'd like is for them to go ahead and calculate the differences rather than us having to look through every manager and calculate it in our heads and have red and green. So that's kind of a no-brainer. But I just thought I'd have them print this out and get your feedback. I'll get the feedback to the other boards as well. We can really only ask State Street to do one custom report, but we would evolve to having this be the way that we look at the performance detail going forward. So it's an opportunity not just to get the net of fees numbers, but to adjust a bit the way we look at the data to make sure it's serving your purpose. I've gotten a lot of comments from trustees, from staff members, and I have seen myself that the way we're doing the reports now is very cumbersome. It's very difficult to find the data. You end up having to spend 20 minutes hunting for data that you really should be able to get in a couple of seconds. And so this is, to me, a lot closer, but it needs the sort of pre-calculated comments. But I'm in a listening mode now, and I'll take your comments. I don't know if you want to gain consensus on the fire trustees or just give me a ring. I will sort of take the input in and come back with a a proposal after some discussions, maybe, if it's okay with you guys, the June report, I'll come out with what appears to me to be the consensus, and if we need to tweak further, we'll tweak further. This tweaking, the board report can go on forever, and I just want to make sure that we get it in the way that you want to look at it. I'll be happy to take any questions. Yeah.
So the number on the public asset fees is 16 basis points, the annual number.
Yep.
What's that? Yeah, on the front page.
Yeah.
So the question I have is, do we have a equivalent number for the private asset classes?
Yeah.
As
A spread. No. Here's the problem with the private asset classes. We report the private asset classes net of fees.
Mm-hmm.
That's the good news, is that all the fees and the carry and everything is taken out. The bad news is that it's tough to parse out what's gross and what's net. New York Times did a piece on this with CalPERS yesterday, explaining this problem. And now that we've done this, that's our next thing. So, and I don't want to drag this out too long, but I just sort of quickly say, I believe that in the private side, the time-weighted returns are bad indicators of what's going on. That the cumulative IRRs, or the cumulative dollar-weighted returns, relative to same cash flows invested in a public market index, are the best way to look at things. And what I'd like to do is to do that gross and net of all fees. Right? What I believe I can deliver in short order is to have it be gross of the flat fees. So we have 2 and 20. It could be gross of the 2. Gross of the 20 is tough because of the way we're invoiced by private equity firms. I have the risk management folks trying to model that to see if it would be an estimate to see if we can model the carry so that we could have gross of carry and the flat fee. But at least what we have now is what we absolutely have to have, which is everything net of all fees.
Right.
You can see
I just think what we want to be able to do is
absolutely.
Say, we're paying 50 basis points a year
Correct.
in total fees on our total portfolio, and this is how it breaks out by asset class. And that's really what we want.
Yeah, I completely get that, and also when you can do gross and net of fees, you can begin to size the how much of the gross return is going for fees and how much is falling down to the bottom line.
I actually think that as we prepare to do our asset allocation review, I think that for New York City in particular, this is a critical piece of information, because it's one thing for a capital asset market model to say, oh, we can generate X with Y asset class, but that's really gross of fees, and we really need to know net of fees. What for New York City? What are we going to get at?
Yeah, well, we do know net of fees, right?
Kind of sort of though.
No.
No, because let me just make the point, right, which we've talked about, which is that I don't believe that even our net of fees number, and maybe Alex or somebody from the private side can correct me, but I don't think that that's taking into account all of the offsets that the managers are charging us for the monitoring fees and
different topic,
transaction fees and all that.
Yeah,
and
different.
So when you really look at our net of fees, it's not just the checks that we write to the private managers for a 2% fee, or even the calculation of how much of the profit they're keeping as a carry. But there's all the other stuff that gets baked in.
John, there are many, many layers of this problem. I'll give you another layer just as an example. In the real estate area and in other areas, if you're using an asset allocator, that asset allocator hires subcontractors or operators and pays those operators a carry. and we never look at anything gross of that. But that, in fact, is a fee and a performance fee that we're paying that's unexamined, so that the gross is a relative term. So what we need to do in understanding this is continue to walk up the curve where we really get the gross returns. And so we're arm in arm with you on this. I mean, we were absolutely committed to this, as are the other major public pension funds, as CalPERS mentioned, and as they mentioned publicly in the New York Times article. So we're on the case there. But what we need, whatever level of transparency we have, we want to make sure we get to the boards and in front of the boards for analysis. And so that's what we're doing now. We do have the ability to do gross of flat fees. We're working on gross of carry, dealing with offsets and the other sort of embedded fees that are considered part of the gross. We'll continue to work on.
I was going to say, I can address how we think about fees in the asset allocation modeling, so you can understand that when I go through the education presentation later.
Oh, good, excellent, Doug. Yeah,
It's pretty straightforward.
yeah, Paul.
I don't understand why this is so complicated. We have people that work for us, they're charging us money. Why don't they just tell us what they're charging us? Why do we have to go searching through all these fees? And so I don't get that. I just don't get it.
Yeah, so they do. Are you talking the private equity or just this stuff? Just this stuff is it's the way it's accounted for, Paul. In most systems, you charge a percentage of daily average assets, and then the accounting system kind of accrues that, every day, and so it's very easy to estimate what your fees are, and so State Street can just quickly do it. New York State's contracts are different. I'm sorry, New York State, New York City. New York City's contracts are more complicated. I'll be happy to walk through it with you in the executive session. They're more complicated, and because of that, they're not as easy for State Street to model out. They can't put them through their typical things, so they didn't. They just didn't do it. Well, it's kind of a critical piece of information for us to understand whether we're getting value. So we figured out a way to model it, which you have here, and I can go through it in detail. We're in public session. I'd rather not discuss the details of our contract in public session, but that's the real reason that it was so complicated. Something that is so basic for most funds. Any other questions on this before I turn it over and we'll go through the asset classes? And please do get back to me on your thoughts. And Doug, I'd be interested in your thoughts as well. Okay, why don't I turn it over to Brian Cook and ETI, who I believe is next. Is that right, or are we going through?
No.
No, we do the quarterlies and then.
Oh, we're going to go through the asset classes. I'm sorry, I was looking at the wrong place.
I'm not sure what's going on. What were you saying? Do you want me to...
No, I'm sorry. We're not quite ready, Brian. We got to go through the other asset classes. You're next,
Quarterly.
John.
Yeah.
I'm sorry, Doug. I skipped that on the agenda. So John Mersberg will take us through equity.
Okay, if everyone would please turn to page 21 in the quarterly fund overview spiral down book. Here we have the domestic equity composite. We see that it was ahead of the Russell 3000 benchmark by 48 basis points for the quarter. It's behind the benchmark for the trailing 12 months and is about even with the benchmark for the longer trailing periods. Turning to page 22, we have the small cap composite. It was below the benchmark for the quarter. It's also lagged for the trailing periods. One thing to note here is that there's a little bit of a value skew in the managers we have, and growth has been beating value lately, so that's part of the reason for that. So moving on to page 23, the mid-cap composite. Composite was ahead of the benchmark for the quarter. That was helped by both the active managers and the performance of the S&P 400 relative to the Russell Midcap. On the next page, 24, we have the Russell 1000 composite. That composite trailed for the quarter, but is ahead of the benchmark for the longer-term trailing periods. Then on page 25, we have the Russell 3000 passive composite, and that's been close to the benchmark as expected. And on page 26, we have the emerging managers composite, which trailed the benchmark for the quarter. Are there any questions on the U.S. equity portion? If not, I'll move on to the international equity. Jump ahead to page 28. Here, the index underperformed the MSCI All World Index. Both the developed and the emerging market portfolios underperformed their respective benchmarks for the quarter. The one thing to note, FIRA is also overweight emerging markets relative to developed markets in the international portion. That may be something Doug will talk about when we talk about asset allocation. On the next page, we have the total developed active composite, and you see a trail for the quarter, but is ahead for the longer-term trailing periods. And it's on the next page, developed passive composite, close to the benchmark. In the more recent periods, there's a little mismatch because we've also got some small cap passive in this composite. And then next on 31, and similar story on 32, developed growth active and value active composites. They both trailed in a strong up quarter, but they are ahead of the benchmark for the longer-term trailing periods. I'll jump ahead to page 33. Here we have the developed small cap active composite, which trails slightly for the quarter. And on page 34, the small cap passive was close to the benchmark for the quarter. And also on page 35, the developed large cap passive composite was also close to the benchmark, as we expected. And moving on to page 36, the emerging markets composite, it was under the benchmark for the quarter, is ahead for the longer trailing periods. And as you can see on the next page, that's been driven by the active managers, which was also under for the quarter, but ahead of the benchmark for the trailing periods. And then on page 38, the passive emerging markets account has been relatively close to the benchmark, as we would expect. Are there any questions on this portion of the report? And if not, I'll hand it off to Yvonne to discuss the REIT portfolio.
So on page 39, you'll see the performance of the FIRE REIT portfolio. Short term for the quarter, the FIRE portfolio surpassed the benchmark by about 52 basis points. And as you look out to the right for longer periods, historically, the REIT portfolio has consistently delivered performance that was at or above its benchmark. Did you get that? Do you want me to repeat that? Okay, we're good. All right, thanks. Moving on, I think the next review is on the hedge fund portfolio.
Yes, the hedge fund portfolio is on page 40, and you can see the trailing 3 months numbers. The total hedge fund portfolio is up 328 basis points. The direct, we've got the fund of funds as well as the direct. The direct was up 348, and that was very positive relative to 279 for the peers, measured by the HFRI fund of funds composite, and the 1-year Treasury plus 4%. So we're doing well in the direct. The fund of funds, Permol fund of funds, underperformed the peers and outperformed the Treasury related benchmark. And over longer periods of time, you can see that similar things going on. The direct portfolio, which is the part we've been growing, is doing quite well relative to these benchmarks. With that, we can turn over to fixed income.
Thank you. So for the most important asset class, that starts on page 42. The pie chart shows the sub-allocation to the different fixed income investments in the major, what we call asset classes or sub-asset classes. Total value was 3.7 billion, which is 34.2%. As you see in blue, by far the largest allocation is the core fixed income, core plus 5 as we call it, allocation, the investment grade program. That program is further broken down on page 43 into its 3 sectors. In blue is the government sector, in green is the credit sector, and in yellow is the mortgage sector. You'll see the overweights and underweights, and we've been talking about this for a number of quarters. We're underweight governments because of low yields and high durations, and we're overweight spread sectors, the other 2 sectors.
Martin, quick question. Given the weight to I guess 2-year Treasury cash, what is our actual kind of, if we were to incorporate that overall, what would our actual kind of weights be within the core fixed income if we were to incorporate the other kind of exposure to Treasury? Like I guess a ballpark estimate.
Sure. So let's turn back to the asset allocation page. Easier to look at that. So on page 11, we show the asset allocations, and you see in light blue the 4% underweight in core fixed income and 4.4% in cash. About 3/4 of that cash is, a little bit more than that, is 2-year Treasuries and agencies, roughly that. So we're covering virtually all of the underweight in core fixed income. Not all of it, but virtually all of it. So hopefully that answers your question. Getting back to page 43, we're underweight core fixed income as a whole. We're underweight government sector labeled Treasuries and agencies here. And overweight spread sectors. You'll see in the index and the actual returns, the best returning sector was the government sector. So that did not help. But as you may have been reading recently, as we've been expecting, we know the timing. Today is the Fed meeting, so the volatility ahead of that, as well as other events, including geopolitical events, has caused Treasury rates to rise, long-term Treasury rates to rise. Therefore, the next quarter, the June quarter, will be showing a good result from this. Nevertheless, you'll see in the difference column, the return for the government sector has been right on top of the managers have been right on top of the index, although the underweight would have hurt from an attribution point of view, and we'll go through that, although we outperformed as a whole. All of the 3 sectors the managers outperformed. In fact, of the 10 managers in the quarter, 7 outperformed. In the 1-year period, 8 outperformed, and the 2 that didn't were in the government sector. And those were, again, not big numbers. Same thing for the 3-year number. But if you look at page 44 at the returns for the core plus 5 sector, labeled total structured, for the quarter the return was 190, just ahead of the benchmark by a couple of basis points. Fiscal year to date was behind, and that's due to what I just described, the underweight to the government sector. That will reverse itself in the quarter that we're in now, as rates have gone from the 180s. It actually hit 2.5 and is now in the 230s. For the 1-year period, the return is 696 versus 710, and again, that underperformance will turn into outperformance in the June quarter for the 1-year period. All the longer term periods, while they have modest returns of 4.42 for 3 years to 6.52 for 15 years, are outperforming the benchmark. Next page is Core Plus. This represents LM, which is your developing manager. if you remember, GIA starting in the June quarter will be included in there. Their performance starting June 1st. But for now it's LM, and similar to the Core Plus 5, similar returns here, ahead of the benchmark very slightly for the 3-month period, behind for the fiscal year to date, and 1-year period modestly, and ahead nicely for longer term periods, which is part of the reason that we rehired LM Capital. Progress, which is the emerging manager of managers, is again, this sounds like a broken record, very similar on page 46. In this case, they're ahead in the 3-month period, behind slightly in the, again, ahead slightly in the 3-month period, behind slightly in the fiscal year to date and 1-year period, and ahead very, very nicely over 100 basis points for the 3-year period. Tips is on page 47, and as you know, we did a search there, and we have a new manager lineup and policy. So the returns here do include the transition and the transition effects, so everything's all included in here on a gross basis. On a net basis, because the fees are so low, you take off a couple of basis points for fees, but that would not materially affect the returns here. But you have Scott's handout for those net fees numbers as well. The returns here for the 3-month period are positive on an absolute basis and slightly positive on a relative basis. Similar fiscal year to date, slightly positive on a relative basis, although negative on an absolute basis by a small amount, and close to the benchmark for longer term periods, anywhere from 2 basis points negative, 12 months and 5 years. And I can tell you this goes out 9 years, similar numbers there, outperforming modestly, which is why we did our strategic decision to go more passive in tips. High yield is on page 48. We have 3 managers there, and for the quarter it was positive by 13 basis points, returning 261. On an absolute basis for the fiscal year to date, negative, and behind the benchmark by 40 basis points, again roughly flat. The 1-year period is down by 29 basis points, returning 2%, and longer term periods are good, with the 3-year period and 5-year period +7 and -7, and that was the time period that we changed the manager lineup. The best performing manager here is T. Rowe Price. If you remember, they were rehired. Loomis Sayles, long term, is best performing manager by far, and they underperformed in the quarter, as we would expect in a volatile quarter. Bank loans is a good story. The managers here have done well on page 49. So on an absolute basis and relative basis, the returns are good, actually quite good. And so this is a good story all around on an absolute and relative basis. Convertible bonds on page 50. This is Advent. On at least for the near term, remember we had Lord Abbott going out further. So for the 3-month period in fiscal year, for the 3-month period, outperforming the overall benchmark, which is in light blue, and their custom and their own individual benchmark, which they manage against in gray, outperforming the overall benchmark a little bit, and outperforming by nearly 200 basis points their individual benchmark, returning by 317. Fiscal year to date, underperforming the overall benchmark and outperforming again very, very greatly, because that benchmark was negative for the fiscal year to date, and they were positive. And similar story for the 12-month period and longer-term periods as well. Opportunistic fixed income is on page 51. You'll see underperformance for periods out for this year. We'll be talking a little bit more about opportunistic fixed income later, and we'll have an annual plan in September, which will show more information. The story here is energy. Similar story to, we talked about this in the last few months. Energy went from being a big part of the high yield index to becoming distressed in the 4th quarter, because energy prices went from over $100 a barrel to barely $40 a barrel. Now we've kind of settled in the 60 range. But for many of the new U.S. businesses that raised high yield money, their break even is about 80. so they've had to cut back, and they're now cutting back to get their break even down lower. So our opportunistic managers have taken some positions there. In the beginning, because those are publicly traded securities, those are very volatile. Long term, the performance is very good, and we'll see how that goes over the next year. ETIs, I'm going to turn over to Brian unless you have any other questions about fixed income.
Thank you. So on page 52, we have the total ETIs, and as you can see, returns are good. Overall, the ETI portfolio without cash is benchmarked is beating his outperforming its benchmark by 65 basis points. I'm sorry, I can't speak this morning. And over the last 12 months, we're up 165 basis points. I do want to note, we as in ETI have always presented our returns net of fees. Unfortunately, last quarter, unbeknownst to us, State Street gave us gross of fees starting in November and December. We have now corrected it, so we're back to presenting net of fees, but the numbers from last quarter were slightly off. It was a back-end problem on their reporting system. I apologize, and it won't happen again. Now, going to the quarterly book on page, we can start going through the collateral benefits, and as we do so, I'll tell you how each program's been doing. So on page 8 and 9 of our big book, we have the PPAR portfolio. It's actually doing well. It's outperformed its benchmark by 482 basis points in the first quarter and 10.98% over the last trailing 12 months. As we talked about sort of last time during the trainings, this is the value of the overall portfolio because these are buy and hold loans. We purchased 1.5 million loans to create or preserve 199 units. In addition, LISC, which is a nonprofit lender, made its first rate lock. This was somebody we had approved back in 2013, so our new lenders are coming online. Going to the next pages, 10 and 11, we have AFLO-CIO HIT. The HIT underperformed its benchmark by 1 basis point in the fourth quarter and outperformed its benchmark by 23 basis points over the last 12 months and invested $8 million in Harry Smith Housing Corporation in that last quarter. Since inception, the Workforce Housing Initiative, which is the latest initiative, has produced 9,339 units of housing and all union construction jobs, I should note. And then last on page 12, we have Access Strategies. Access Strategies outperformed its benchmark by 50 basis points in the first quarter and 207 basis points over the last 12 months. And in the first quarter, Access purchased $10 million of Ginnie Mae securities for Christopher Court in the Bronx, as well as purchased $5 million in Fannie Mae securities for a Little Italy project in Manhattan that will restore some Section 8 units. And I should note one other thing with FIRE. During the presentation, I showed you the location of where all our investments are. One of the things that we were doing is checking and actually verifying what our managers were saying where the investments were, and we did find an error in Access's information. So there were, in effect, 3 loans that were in Brooklyn. Two were said to be located in Manhattan, 1 was said to be in Queens, so now you have purely clean data on where the loans are located, and these charts are absolutely correct. And if there's any questions, if not, I will turn it over, I believe, to Alex Donier.
So we have the private equity quarterly update. As a reminder, private equity is on a lag, so we're going to be reviewing fourth quarter of 2014, December 31st, 2014. Overall, we had a very nice quarter to report. I actually did want to introduce a member of our team, Inosh Kajela, who joined us over 4 months ago now. Happy to state that, as you know, we've been working on rebuilding the private equity team. We now have 5 members of the PE team, which is larger than the PE team was prior to Scott joining New York City as CIO. So we're happy to have a kind of full force team. And I'm actually going to turn it over to Inosh to walk you through the highlights of the fourth quarter of December 2014.
Thank you, Alex. Good morning, everyone. I'll be walking you through a private equity quarterly report that's ending December 31st, 2014, beginning on page 26 of your agenda package. And on page 26, we have a snapshot of your commitments and overall portfolio performance. And at the top of the page, you can see your active commitments. And as of December 31st, 2014, FIRE had $1.4 billion in active commitments across 105 managers, with a market value of $735 million and unfunded commitments of $490 million, which results in a total exposure to the asset class of $1.2 billion. And if you look at the bottom of the table, you can see that the portfolio's since inception net IRR has remained constant over the prior quarter at 10.9%, and the net multiple also remained constant at 1.37x. Now let's take a quick look at page 25. It's one page back for some quarterly highlights. In cash flow activity, during the fourth quarter, the portfolio was cash flow positive by about $1.7 million, and the portfolio has been cash flow positive in 5 of the last 9 quarters. In recent portfolio activity, you'll notice that both quarter over quarter and year over year, the portfolio value has increased net of cash flow activity. So the portfolio value over the prior quarter increased by 2.6%, or $18.3 million, and over the prior year, the portfolio value increased by 9.7%, or $65.2 million. Next, under new investment commitments, FIRE closed on 5 commitments during the quarter, an aggregate of $11.9 million to 5 managers. And subsequent to quarter end through June 3rd, 2015, FIRE closed on an additional $21 million in commitments to 3 managers, including 1 emerging manager. I'd like to now turn to page 28, where you can see your portfolio's returns presented over various time periods and against the program's benchmark. Since inception, the portfolio generated a 10.9% net IRR, which lags the program's benchmark by 260 basis points, but it is now outperforming the Russell 3000. On a 1-year basis, the portfolio generated a 9.7% net IRR, which does trail the program's benchmark due to continued outperformance of the public markets. However, given that private equity is a long-dated asset class, we believe that the 10-year and since inception figures are the most relevant. Let's quickly turn to page 30, where you can view the portfolio diversification. And you'll see here on the top part of the page under strategy that the portfolio remains diversified by strategy, with buyouts representing the largest exposure, 52% relative to a 60 to 85% target. And we expect this exposure to increase as we continue to source and commit to high conviction buyout managers. Turning to page 33, you will find a summary of the portfolio's quarterly cash flows through December 31st. And as I previously mentioned, you'll notice that the portfolio has been cash flow positive in 5 of the last 9 quarters, which demonstrates the portfolio's self-funding ability as it continues to mature. And lastly, I'd like to turn to page 35 to look at geographic exposure at the portfolio company level. On the bottom of the page, based on current market value, North America represents the largest exposure at 78%. Europe is at 17%, and the rest of the world is at 5%. And we also show here on this page New York State and New York City exposure. And in terms of exposed market value, 6.8% of FIRE's portfolio is exposed to New York State domiciled companies, and of that, 5.9% is exposed to New York City-based companies. And I'll open that up to questions.
An update, yeah.
Yeah, just a quick update on it. But that, you know, as we were talking earlier about having the cumulative IRR numbers, the numbers that Anash mentioned on page 28 are those critical numbers, the cumulative numbers versus the similar calculation if we had just invested in the market at the same time on a dollar-weighted basis. And I think that is a very good comparison. As Anash mentioned, those numbers are getting better.
And if I may add, those numbers do include all fees, both standard fees, carried interest, and all other creditable fees back to the pension plan.
Well, I have a question about that, if I might. Did you say credible or creditable?
Creditable. So we have been in funds in this program for 15 years. And while today we strive to negotiate offsets at 100%, that has not been the case throughout the life of this portfolio. So there are fees that are generated by our GPs in earlier vintages in particular that are not 100% given back to us. So that would not be included here because they were not given back to us. Sure.
But it's reflected in the market value.
Absolutely.
Yeah. So let's
Right,
make
but
sure
the question,
that
here's the question really I have, is when you say that we pay a fee, if it's in the form of an offset, which is what most of those fees are, as I understand it, in other words, it's an offset against the management fee, are we reporting that we paid the full management fee?
No.
No.
No, sorry. Let me answer the question.
Okay.
What this includes is our gross fee, all right, and then it takes into account the fee we get back. So to do the simple math, if we owe $1 on a gross basis, but we have an offset of 50 cents, the fee reported here that we paid out of pocket was 50 cents, right? That's
reality, we're really paying $1. That's my point, really.
Cash flow out is 50 cents. We did not pay $1.
I understand cash flow out is 50 cents.
Right.
But our account is being charged $1 because of that offset comes really, it's like taking it from one pocket and putting it into another pocket, right? In other words, if a portfolio company that we own pays the private equity firm 50 cents, right? Or say it pays $1 and we get 50 cents of it as an offset. Well, we're still paying it, right? Because it's coming out of the pockets of the portfolio company that we own. That's my point. Even though we're not writing a check for it.
Use the word incurring.
Right.
Incurring, fine, incurring.
Yeah. Just like when we own stock in Budweiser, we incur the cost of the managers of Budweiser running the company. Right? And
Right,
it's similar. We're owning a private company.
Right.
And if they're paying board fees to a private equity manager that helped fund them with our capital, then I mean it's a similar kind of explanation. And so the market value that you're reporting here,
Doug, right, is that we're supposed to get 80% of the profit from investing in that company. But if the company is paying out a portion of that profit, or whether you want to call it profit or not, a portion of it.
I wouldn't call it profit.
It wouldn't be profit, it would be part of their expenses.
Well, right, but you see what I'm saying?
So could I suggest, this is the CEM paper issue. Could I suggest this is a pretty deep topic that I think is a very interesting topic, one that it's not, it's not completely clear what the right answer to is.
I agree.
I would invite, any of the board members that are interested to join Doug and Alex and his staff and I in a conversation to think about this from a theoretical proposal, and then come back to the full board with conclusions, because I think it's this is one we probably could debate for 2 hours.
Sure.
And it's a good, but it's a good topic.
Thank you.
Anything else?
Thank you.
Okay. Next up. Yvonne, can you hear her there?
It's fine.
Yeah.
Okay, so real estate continues on page 43 of the bound board book, and we're going to review the highlights of the fourth quarter 2014 for Fire's real estate portfolio. And similar to private equity, there is a quarter lag, so we'll be reporting on fourth quarter 2014. But what's important, particularly in real estate, every fourth quarter, is that it is the quarter where we do get a third-party validation on value. So managers, GPs are estimating value. Those values are being scrubbed and checked by the third-party auditor who has to prepare the audited financial statements for the year. And also, in some cases, some of those assets are also appraised by a third party. So at a minimum, all valuations are being checked by third-party auditors, which certainly make us feel good. And this is the quarter where sometimes you'll see the biggest rise or fall depending on where the markets are. And for real estate, the global real estate recovery continues to firm up, with the U.S. leading the way. In terms of transactions, we see it in transactions. There's a 20% increase in transactions overall in real estate, and that's also being fostered by the fact that there is a wealth of debt available at very low rates, and that continues to occur. Also, strong demand in gateway cities. We saw that when recovery first started, that investors were definitely moving toward London, toward New York, San Francisco, world gateway cities. And now those cities are somewhat overheated, seeing values very close to the pre-crisis. And so now you see investors finding value in more secondary cities like Miami and Austin. And so let's see how that translates to the fire portfolio as we kind of review some of the stats there. So there's an allocation to real assets of 5% and plus or minus 2% for rebalancing. And in terms of real estate, which is part of the real asset category, we have a market value of $436 million. And unfunded commitments, which are commitments that have been authorized but not yet funded, in the amount of $165 million. So our total exposure to real estate for the fire portfolio is about $600 million, which is comprised of 46 investments, which are being run by 34 managers. Those managers are executing both core and non-core strategies consistent with our IPS. We are looking to kind of achieve a portfolio mix of about no less than 40% core strategies and no less than 40% non-core strategies. As we stand today, there's an overweight to non-core. We're about 2/3 non-core strategies and 1/3 core plus strategies. And if we look over to the lower right of page 44, we'll have a chance to see how that's kind of impacted the portfolio. Near term, again, I talked about the importance of the fourth quarter. You'll see that, first of all, in the bar graph, fire is the dark bar and our benchmark is the lighter bar. Our benchmark is Odyssey plus 100 basis points, 100 basis points in recognition of the fact that our benchmark has strategies other than core strategies, as well, has opportunistic as well. So as we kind of look over to the left, we see that the quarter, the fire portfolio returned 4.1%, which was 80 basis points higher than the benchmark. And as you look to the right for the 1 year, the 3 year, and the 5 year, you'll see that the fire portfolio has surpassed its benchmark significantly. As you kind of, if you could draw an invisible line from the 5 year in between the 10 year and since inception, I would say to you that over to the left where we have the outperformance is all post-recession performance. And as you know, we've worked very, very hard to focus on top performing managers that are able to deliver strong, consistent returns in good times and bad times. Kind of sharpened our pencil there. As we look over to the right, the portfolio, it reflects investments that we made pre-crisis, And we do have some legacy investments there with some mixed results. But as you can see, there's a wall of outperformance moving over to the right, and hopefully an indication that we're moving in the right direction. In terms of investment activity, we closed on H2 Special Ops Fund 3 as a re-up, $15 million there. We upsized our commitment to Blackstone Europe 4 by $6 million, and also was able to close a $31 million commitment to BREP Global Fund 8. Since the quarter, we've committed about $19 million, additionally to another 3 managers, and including 2 small cap managers. So I'm going to turn the page, and I'll be referring to the page numbers on the bottom. So at page number 2, it's just a snapshot again of the portfolio by investment style. If you look at the circle graph there, it depicts the fact that the portfolio as it stood fourth quarter was 67% non-core and 33% core plus. In terms of the cash flows going in and out between the systems and the managers, we contributed $31 million and got nearly all of it back in terms of distributions with 28. So we are striving to be self-sustaining, and with each quarter we get closer and closer to getting into that position. In terms of where the program sits today, we're about 4% invested, and we are 5.6% committed to real estate at this particular point. Moving on to the next page, takes a different look at the portfolio. We talked about the core and non-core sides. And this page takes a granular look at which investments are driving that performance within those 2 sectors. So in the core plus area, we have about 13 investments, which in this particular quarter was driven by related, and that component of the portfolio delivered a net return of 3.1%. The non-core portfolio, where we have about 31 investments, was driven for the quarter by 4. And more narratively, if you turn over to the next page, in a different way, it shows you the investments that were driving the performance for the quarter. Again, real estate is a long-term asset class. It really is very helpful to have this information at such a granular level. But again, this is just a quarter. And again, we mentioned for Taconic and Carlisle, if you look at this graph, it's showing you who's driving performance by looking at the bars protruding out to the right. Those are the outperformers, and as you look down toward the bottom, the bars protruding to the left are the investments where the performance are below average. We manage risks as best we can in real estate by various metrics, and if we turn over to the next page, page 5, you will see how the portfolio is diversified by property type, apartment, office, industrial, retail, and other property types. And at the bottom, it shows you how the fire portfolio is diversified by geography. I guess 2 takeaways here. Over to the right, you'll see that our international exposure at this point is approaching 16% at 15.7, and also in terms of our New York City exposure, the bar on the little triangle on the right indicates that our New York exposure is about 13%. And that just about covers the overview of the performance for fire for real estate for the fourth quarter 2014. And I'll take any questions. If not, I'll hand it over to Petya, who's going to talk about the complementary side of real assets.
I just wanted to ask one question.
Sure, John.
We have 46 investments and 34 managers, that's correct?
Yes.
Would we be better off if we had 24 managers or 46 managers?
Yeah.
How does that work?
No, I hear you and I agree. And if you recall, when we discuss in our annual plans, we talk about streamlining the manager pool. And I guess I was saying it in a different way, and that we were focused on the top performing managers. And so we're going to lose maybe 20-25% of our managers just through attrition, because based on their underperformance, they're not getting another dollar.
Okay.
So we're a little fat right now, I agree. But the goal is to have an efficient number of managers that we have expanded relationships with.
Thank you.
Good morning. My comments would be very brief. It's about infrastructure. It's the newest asset class in the portfolio. So if you turn to page 56, the performance summary is there. What it shows is that as of December 31st last year, the infrastructure program for fire has committed $35 million and contributed $4.5 million of capital to infrastructure. The program includes 3 managers for that time period. If you look on page 57, you would see the performance relative to the benchmark. The IRR is 13.7% as it compares to a benchmark in this particular quarter of 5.7. The benchmark is it's correlated to CPI. It's a CPI plus 4. Therefore, the benchmark varies as CPI changes. So in December, CPI was a little bit lower than in prior quarters. I would like to draw your attention to page 67. On that page, you would see the exposure by geography. And again, it's early stages, but it gives you a little bit of a flavor as to how the portfolio is developing and where we are at this stage. It's focused primarily in North America, 75% of the current portfolio, with around 25% in Europe. And in terms of sectors, it's, again, early stages. Primarily, we are right now invested in renewables, 59%, around 23% in energy, and 19% in transportation.
One question. The current cost on this page, is that the value you kind of bought it for, we committed, or kind of the at a particular mark or book value? I was wondering the difference between current cost and I know what current market.
Right. This was where we bought, and market value is where they're valued today. Well, at the December 31st. Yeah, sorry. And this concludes my remarks. The portfolio, again, is in early stages. It's developing. Still not too much complexity there.
Thanks very much, President. Okay, so I think that brings us now to ETI. Jump the gun. And why don't we turn to Brian Cook and his theme?
He did.
Oh, okay. I am really confused. All right. Okay, so now we'll go back to the monthly report, which is right here in the flip book. So I'll just quickly cover the, we already covered the performance, so let me cover, I think it's about on page 30, the portfolio structure. No, adjusted is on page 32. So this is getting a little dull. I tell you the same thing every time we meet. We are trying to stay close to policy in the various equity categories on the left, and we're right on it, as you can see from page 32. You know, everything's within 10 or 20 basis points of the long-term asset allocation target. We're underweight long-term bonds in blue, and the inflation linked in purple, and overweight short-term. This is called cash, but it's anything under 4 years duration. We're at about 2 years duration on that. When you combine the cash with the long-term holdings, we have a similar duration to the Barclays Agg. And so what we've done is reduce the overall duration somewhat, or interest rate sensitivity in the slow interest rate environment. So if interest rates go shooting up, we will be no more affected than the market. And that would not have been the case if we were on our long-term targets. So it's a bit of a defensive measure. As Martin mentioned, the last quarter, that's we get a little wind in our face, but we believe that this will pay dividends for us in the form of losing less money as we move forward and regain more normal interest rate environment over the next couple of years. Martin, you want to take them through quickly? Any highlights in the macro environment?
A couple of things. Just to notice, a lot of these have been in the news, so I'll be quick. On pages 15 and 16. See, remember the dollar was strengthening versus the euro and the yen.
Yeah.
That has abated and come back down and stabilized. You'll see that the euro is now on page 16 in the low 110s, 12, 110. The big issue there is going to be Greece. The question is, if Greece exits, obviously it'll increase volatility. Would that then bring it close to the parity? In other words, reducing the value of the euro. And there's the school of thought that if Greece goes out, it's better for the euro because now what's left is better. So there's truly no way to find out until it happens, if it happens. Another thing that's stabilized on page 17 is price of oil. You'll see the time we printed this was page 17. It was 58 change. It's stabilized at around $60. You'll see for quite a while now, for about a month, which is good. Volatility on the next page you'll see is still quite low in the U.S. 15 is a low number for the VIX. Big story for us on page 20 is the 10-year Treasury. That's what Scott was referring to, that I was referring to. While it doesn't look like much on the chart, we're talking going from 180 and change up to early 240. Right now we're in the 230s, in the low to mid 230s as of this morning, although we did hit 250. This is what we were expecting to happen. Today the Fed makes their decision. The consensus is they're not going to increase short-term rates, but who knows? At some point they will. That's when volatility will increase, and likely short-term rates obviously go up, but long-term rates, the knee-jerk reaction will be to move, and then it will settle, but it will be higher than it is today. A few other points to point out. Well, how did we do in April? If you turn, it's hard to see the page number on page 27. That's this over here. April was a good month, as we told you last month. The first set of numbers on the left, you'll see the Russell 3000 was up about 0.5%. Big stars were non-U.S. equity. EAFE was up over 4%. Emerging market debt over 7.5%. Core plus 5 was down because interest rates started moving.
I think you've got to speak up.
I'm sorry, Core plus 5. I realize you got the vent over there. I'll sit over. Core plus 5 was down about 1%, but all risky assets did well. And so if you turn to, I'm going to skip a couple of pages. If you turn to page 31, you'll see the return for the month was just shy of 1%, as we expected, bringing the fiscal year results to 4.53%. In May, it was continuation. It was another good month. So the Russell 3000, if you turn back a page, was up over 1%. EAFE and emerging markets were down in this case. Core plus 5 continued to go down because rates were going up. But risky assets in general did well. And so the return you'll see next month will be probably have a 5 handle. Recently, before this week, the equity markets came off their record highs. They're now starting to come back up. So I would expect, as of today, the market value for FIRE. So let's turn to that. As of the end of April, on page 37, was just shy of a record high, over $11 billion. In May, you'll see a new record high. I would say as of today, we're probably very close to where we are today. I'm sorry, as of today, we're very close to what we're showing as of April, because the market went down, then came back up. And the 10-year return is 7.44. Scott's already gone through page 32. I think he's gone through page 32, but you see we're exactly where we want to be, flat versus the equity targets and underweight core plus 5. The numbers are shown in percentages and numbers on pages 32, 33, and 34. And the rest of the book shows each and every manager versus their benchmark. Are there any questions? Thank you.
Okay, great. Thanks very much, Martin. We can now turn to Doug in the trustee education session.
So we had I think a good discussion at the last meeting about the plan for the rest of the year and having a formal discussion about asset allocation later in the year. And we talked about having an educational session, maybe like a quick primer to help tee that up a little bit. And so that's what we put together here. Oftentimes when you have an asset allocation study or even a more formal asset liability study, it can be a process that takes multiple meetings. And so I think setting it up makes a lot of sense. And so that's what I'd try to do. So maybe I'll start out on page 2 just to kind of maybe go over our view of what the hardest part of your job is. We believe at our firm that asset allocation and setting that policy is really the most important decision you make, and it's something you should make using as many inputs as possible. And it will ultimately drive your decision, your results over a long cycle. Year to year, some of your implementation will definitely have more of an impact. And I know as we just went through those quarterly reports for the total fund and for your public asset class managers and your private market managers, that we spend a lot of our time on implementation. And the staff spends a lot of their time on implementation. And in part, that's a function of your size, but also the complexity which is set really through this process and this discussion. The hardest part of your job is that we take this data from the quarterly report and we can compare it to NEPC's asset class assumptions today. We can look at what NEPC was telling you 2 years ago, 3 years ago, 5 years ago, and talk about how the results have tied into the planning that we did years back or that we're doing now. But the hard part of your job is that we have to, if we're going to adjust our policy, we're making decisions about how we want to position the portfolio in the future. And we have a lot of hindsight that we can use, but unfortunately that can also, it can inform us, but it also can create kind of biases or traps or, kind of behavioral conditions that make us think about what we should do in the future. And the best example of that is when the public equity market is delivered 15, 16, 18% returns in a 3 or 4 year period in the U.S. market, and maybe the non-U.S. markets only delivered half that. It's easy to think, well, maybe we made a mistake because we had more of a balance in our portfolio. Maybe we should have had more of a bias towards the U.S. market. That's our home market, that type of thing. Those are the types of decision traps that I think we see. And that's really the hard part of your job, is you have to kind of look at it and think about what happened in the past. And there's always, in investing, the best performing public pension fund in any time period can always look back and say, wow, we could have done something differently. We would have done better than we did, even though we think we did great. So that's the hard part of your job. So when you talk about defining your objectives, I think, that's really where you look at the asset classes that are available to invest in. You look at trade-offs like return and risk, but also things like fees and complexity and liquidity. And those are all the kind of inputs in terms of the asset side. But the bigger part of it is also tying it into your liabilities and looking at what the kind of life cycle of your plan is going forward, the cash flows that are going to be required to meet the needs of the different participants, how the plan will mature over time, and then whether any changes to the plan, whether they have been made 5 years ago or are contemplated in the future, how that will affect your planning. We believe, importantly, that when we do the asset allocation modeling, that it's very important to look at it from multiple perspectives. There's a lot of discussion now about risk management, risk budgeting, factor-based investing. All those things are all very interesting, and they're, in a sense, just a different way of framing the question of balancing risk and return and exposures and then monitoring those. And so when we look at our asset allocation process, we look at it using what I would call the traditional approach, which is called mean variance optimization, which is a very technical term, but all it means is that you come up with a set of assumptions for the different asset classes that you want to consider, and they may be all the asset classes you already have exposure to, plus maybe some 2 or 3 that you don't have exposure to that you want to consider. And you develop a forward assumptions that really take on 3 components. One is the return. What do we think the return will be going forward? Over what time horizon? What will be the risk? And for risk in the mean variance framework, we use standard deviation, right? And if you think of the bell curve, right? If any of you guys failed statistics like I did in college, right? Or maybe the first time I guess I did. I had to take it over. But when you think about the bell curve, right? If we're talking about the average temperature in the city of New York in a given year, and we say that's, let's say it's 62 degrees, right? It all balances out, the hot summers and the cold winters. When we talk about standard deviation, we're saying how wide are the observations around that average, right? Because we know that average might move, right? If we believe in global warming, we may think, oh, it's going to go from 62 to 65 in the next 10 years. But we want to look, when we talk about risk, at the variability and the range of that. And that's a key input. And then the last input is a little more technical. It's called a correlation. And that's essentially looking at how different asset classes move and behave in relationship to each other. Do they behave in similar fashion in different situations, or do they behave very opposite? And that's an important assumption. It's also one of the harder ones to incorporate. So we take those 3, and when we talk about an optimization, all we're doing is saying, what are the best combinations based on those assumptions, right? Without any constraints. What are the best portfolios? What are the best portfolios in terms of the best balance between the highest return I can achieve per unit of risk? And so that process kind of moves forward, and we supplement that with lots of different kind of other alternative ways of looking at your portfolio. Risk budgeting is looking at the sources of the risk in those projected portfolios. Where are they coming from? A lot of times they're coming from the equity portfolio. Looking at scenario analysis, that's where you say, okay, here are our assumptions. We're going to use those as our baseline. But what happens if inflation spikes? What would happen to those assumptions? How would they break down? Or what happens if the economy takes off and grows more dramatically than we anticipate? Are we going to leave money on the table because we didn't have a lot in risky assets? And that's what kind of scenario analysis looks at. And so if you look at page 4, when you talk about the goals of the process or the key questions to answer, we have with this plan a great balance of risk assets. We have equity-like assets, including public equities, private equities, and other asset classes like real estate that have attributes of both. And then we have kind of perceived lower risk assets like bonds. But determining the total equity ratio, or that balance between the lower risk assets and the higher risk assets, is important. Deciding how much liquidity risk we're going to take is also very important. Increasingly public pension funds have been willing to take to lock up more of their capital in illiquid asset classes, and there's a reason for that. In general, you get paid to do that, right? And also, public pension funds have a very long life cycle, right? And they have a very long time horizon. And so if they can afford to lock up money for 5-10 years, it'll make sense if they can select assets that'll achieve a higher return as compensation for tying up that capital and not being able to reallocate it in different periods of time if market conditions change. And then Other things that are typically discussed are things like economic hedges. When I talked about that optimization process, we have an asset class in the portfolio right now, TIPS. And when you do the optimization, the modeling doesn't really point you to have any allocation to TIPS necessarily. But we may, as a group, also look at market conditions and say, setting aside the parameters of the model, we think it's important to have inflation protection because we know that inflation would impact a pension fund differently than, say, maybe other types of investors. And so we may decide to make a non-economic decision or try to hedge a certain risk by having some inflation risk protecting assets like TIPS or maybe commodities. And then currency risk is also important. We're a little bit spoiled in the United States in that we have the largest bond market and really the largest stock market in the world. So our home base, where our assets and our liabilities reside, has a great opportunity set. If you look at a pension fund in Canada, if they have a 50% equity ratio, they might have 20% of that in the U.S., 20% of that in the other countries, and 10% in their home market. They look at it differently because the opportunity set in Canada is much more narrow, the market is smaller. So they look at it broadly and then make a decision about the currency risk they want to take relative to their liabilities. And that's the way most countries have to deal when they look globally at asset allocation decisions and opportunities. In the U.S., I think we also factor that in, but we've been a little bit more, we've benefited a little bit more from the large opportunity set in our home market. Increasingly, that's changing. And then when you have these discussions, again, what asset classes that you don't have exposure to would you consider? And I put two down here, and these are really the two that we've talked about back 3, 4, 5 years ago. If, again, the basket clause is a big determinant of this because we've got our assets allocated right now and our private market commitments pacing set to hit that 25% basket. And so if that, we've talked about how important that would be to create a little bit more flexibility, not necessarily to take more risk, but to have more balance in the portfolio. And candidly, if we were to advocate emerging markets debt or commodities, most of that new allocation to those different categories we would source from your equity ratio. So we'd be trying to get your equity ratio down a little bit more, spread your bets out. Emerging debt is an asset class that is a bond, but it has equity-like risk. It just has a little bit of a different return pattern and right now a very attractive yield, even though you may read in the paper a lot of negative things about emerging markets. Fortunately, that's the time to kind of consider those markets when other investors are shunning them or moving money away. And I know there's a search plan for later this year, even though the basket issue hasn't necessarily been resolved. Your liquidity needs are very important. And then, of course, tying that into liabilities. I know we have a new actuary that just came on board, and I'll be reaching out to her to try to get a meeting and update, give her some perspective on the plan and get her perspective as well. So just going to page 5, that efficient frontier that I talked about. Again, the box on the top right tries to quantify, again, looking at the parameters on the two axes, return, expected return, and volatility. As you go out along the volatility or the risk spectrum, do you get paid to take more risk? Meaning, does that line slope up and to the right? And where would we want to be on that line relative to things like our liabilities and our desire to have our funding ratio try to be as stable as possible, and the funding that participants in the city have to make to the pension fund. We don't want that whipping around because the markets are moving. We want to try to stabilize that as much as possible because we have a funding schedule that sets it out over time, but it adjusts it and it can be smooth. But we want to keep that in mind as well. The chart in the bottom right is an interesting chart. It looks at how the model performs. Essentially, it's relatively complicated, but essentially it's looking at how an additional allocation of 2% to any asset class might impact a balanced portfolio. So we took a, kind of an average portfolio for one of our clients and said, if you wanted to increase risk or decrease risk, what are the different asset classes impact on those? You can see real estate, which is represented by RE, is one of the asset classes that the model likes, if you will. I'll use air quotes on that, and that it enables the plan to, if they're increasing their allocation to real estate, it generally helps you maintain your expected return, but overall, relative to other categories, reduce your volatility. So the model likes real estate because of its risk-return categories, hedge funds as well, and some of the credit sectors, and I mentioned EMD. Yeah, it's not taking your portfolio. It's a general chart, but it's trying to show you how considering new allocation, right? Like large cap, for example, is in the red. So what it's saying to you is, if you want to allocate based on our assumptions to large cap right now, just bump up your large cap U.S. equity by 2%. It's saying that you'll do that. You'll add incremental risk, but not necessarily improve your return. And that's based on the way that the assumptions that we've set right now. And that that sentiment is captured on page 6, where if we decided today as a group that we wanted to take less risk, right, we would try to maintain our expected return. So we'd want to try to reduce our risk and get in that top left box, if you will, while maintaining our return. But if we decided that the return that we project for this fund isn't enough, we need to get another 20 or 30 basis points, we're going to have to take on incremental risk to get there. And those are the trade-offs that we would discuss with clients. And I'll just quickly go through our assumptions in the appendix on page 12. So we update our asset class assumptions every year, and most of our competitors do as well. Some of them do it quarterly. And what we try to accomplish with these is we look at the past, and then we look at current market conditions. So the best example of that is a cash yield. We know today that the cash yield is below 25 basis points, right? But we have to have a time horizon for our assumptions. We don't think we're good at predicting what's going to happen next year or in the next 12 months. We think that you can look at market conditions and have an expectation over what we use here as a 5 to 7 year assumption. And right now, cash rates, for example, are around, when you look at the forward market or you look at some kind of expectation over 5 to 7 years, NEPC and the Fed and the market assumes that cash rates, as Martin was talking about earlier, are going to glide back up towards where they've been historically. And historically, cash rates have been closer to where inflation is. So when you're holding money in your money market fund and you're earning 3% over time, if that's roughly equal to the level of inflation, you're not getting penalized on a real basis for letting that money sit in cash. You may not make anything on a real basis, but you're generally not getting penalized. Right now, as investors and savers, the cash rate being at 20 or 30 basis points, if we believe in inflation is around 2 or 2.5, we're getting penalized. We're actually losing money on not only cash, but also where our bond yields are right now. And so what's really important when you look at a page like this is more the relationships between asset classes, not so much whether the 6% for large cap is going to be absolutely on target over the next 5 to 7 years. It's whether it's the relationship between large cap and bonds or between large cap and private markets. And now to John's question earlier about fees, or you mentioned at the initial discussion, the way that we set these assumptions is we don't assume any value added from active management. So these are designed to be a beta. So just passive management. Now, many of these categories you can't passively manage. But I'll give you an example. Private equity, if you look at the return assumption for 2015 in that middle column, we use 8.5%. If you look at large cap, it's 6%. What we assume here is just a liquidity premium for investing in private markets. So just the premium or the beta that you would get from investing in illiquid assets, not any value add over, driven by manager performance. And the reality is, we think this is the best way to model it because it's conservative. We're only assuming 2.5 over. Your plan over time, when you look at different numbers, in the monthly report, I think the number I saw on a time-weighted basis for your total private equity composite was like 11.5%, and that was maybe a 10-year number. Sorry, and your 10-year number for equities is like 8.5. So right now, the shorter-term numbers, 3 and 5 years, kind of look a little bit bad because we're assuming 3% over the Russell 3000, which right now is in the 19-20% range, and the Russell 3000 looks great. But believe me, when there's an equity market correction, then your private equity numbers are going to swing in the opposite way, and you're going to be like, well, that's a crappy benchmark because look at private equity is doing so much better. And it's really the long cycle that's important. And I think over the long cycle, Alex and his team are trying to develop a portfolio that's going to return you kind of low to mid-teens net of fees. And we're modeling it more conservatively by only assuming a 250 basis point spread over public markets. Now, you may challenge the 6% number for a large cap. Is that a crazy number? We don't think it is based on where we've been in the last 3 years because PEs right now are higher. So the starting point is important. We also look at it relative to bond yields, right? The bond yield for core bonds we have there, which is really a roll-up of a mix of treasuries, corporate bonds, and mortgages, kind of like what you do with Core Plus 5, we only assume is going to earn about 2.3%. So that spread over bonds in terms of the equity risk premium is still at a pretty high level, but the 6% number we think is realistic based on where we're starting. We're starting from a point where the average PE in the market, whether you're looking at current or forward or normalized, is much higher than it was 5, 6, 7 years ago. And then also,
by the way, that 2.3% is virtually on top of yield.
Right. So in the bond market, yield is a great predictor of future return. Rates can move up and down. They're typically range bound in a 5 to 7 year cycle. But remember, the last 30 years, bond yields have been coming down. So we've been getting our coupon plus appreciation. Now we think we're into a mode where we're going to get our low coupon plus some negative depreciation. And so that's what we're a little bit worried about when we think about the bond market. And I think that's really what's driving the positioning that we have in place. We've got to underweight to the government sector because effectively that's the most interest rate sensitive, but we've offset that with short government bond exposure in the cash bucket. I don't know if there's any questions at all. One other interesting, just kind of relative comparison, U.S. equities at 6, we have the same return expectation for small and large. We don't see a big spread there in terms of the difference going forward on this cycle. And then international, you can see, is over 7. So we see the non-U.S. markets as being more attractive. These were developed at the beginning of the year. Private debt is really our proxy for opportunistic fixed income, which you've added. And then private real assets is really what you've moved into, splitting up your real estate and your real asset exposure. Commodities we don't have, hedge funds we have exposure to. I'll just mention quickly, the risk numbers are on page 13. The other thing that we do with private markets to be conservative in the modeling is private markets don't have a lot of experienced volatility, meaning we're looking at the quarterly valuations and they don't move around that much. But in the modeling, if you put kind of the historical volatility of some private equity index in there, it would be really low, and it wouldn't really be reflective of what I characterize as the range of outcomes in private equity. Right, you're locking your money up. We know that if you look at any of the peer group data, that the median number has a lot of variability around it. Right, if I tell you the median return for the 2000 vintage year was 11%, well, we know there were a bunch of funds that were probably down 20%, and there were a bunch of funds that were up 30%, right? And so there's a lot of variability. And so we, in a sense, artificially penalize private equity by assigning it the highest volatility number at 27%. And I think it's a reasonable thing to do when you're modeling. the asset allocation modeling and the mean variance modeling is I always say it's a blunt tool, right? You can almost make it say whatever you want by putting in assumptions that are, kind of tweaked in whatever direction you're trying to convince yourself to go. But you need to kind of step back and see it for what it is that the model has biases based on the assumptions you put into it. The last thing I'll mention is on page 14, because our clients, in particular our public fund clients, have long time horizons and they work with their actuaries on 20, 25, 30-year amortization and funding schedules, we also have 30-year assumptions, which you could also think of as being like normalized assumptions. So cash goes back towards where it has been, closer to an inflation rate of around 3.25%. Government bonds, other bonds get closer to 4%, which is still not that much higher than they are today. In part because we're penalizing them a little bit for what we see as the negative price appreciation to come. And then you look at equities, they get back above 7.5%, 8% or so, and the private markets get closer to 9%. So again, we still think these are pretty conservative. They've been coming down year over year. We've got the last year's and this year's, in part because bond yields are coming down, and that creates kind of a floor in the relationship between asset classes that move. And that's all I had. I think that's just a good primer to get you thinking about how important the assumptions are and the process we're going to go through. And I know if there's any feedback you have or questions that you can filter through, you could send directly to me or through BAM. Happy to kind of incorporate questions you have into the process that we go through in the fall.
We'll be working closely with Doug and his team as we go into this. This is very helpful. Questions?
Just 2 questions, Doug. First, I guess your assumptions on treasuries on page 12. Is this kind of just like the average duration of the treasury market, or is it a particular kind of is it a 10-year or is it in general kind of your?
I think you should think of it as a 10-year. Okay. The way that we do our fixed income assumptions, we look at the current yield, and then we also look at the derivatives market, the forward market for rates and spreads, and use those numbers. But I think for the most part, you should think of treasuries as being a 10-year. Investment grade credit would have a duration that was somewhere around, I think, 6 or 7 at the most.
But as I mentioned before, Antonio, I have numbers as of June. Of course, rates have gone up a little bit since then. His 2.3% is just below the yield to maturity of the Core Plus 5 in the 2.4 to 2.5 range. And historically, the average life is 7-8 years. And that's a very good predictor. 7-8 years from now, the return is going to be 2.5%.
We actually have a chart, right, where we look at it's a line chart, right? So it just looks like a mountain, and essentially it looks back every year at the current yield, and so one line is longer, but it looks back 5 years, I think, or 7, 6. I think we did a 6-year rolling chart, so it looks back 6 years and compares the yield 6 years ago to the return since then on that following 6 years. And the chart it's right on top.
We did that internally
ridiculous.
Several years ago,
and I'll include that in the deck.
Other than being at the end of 2008, it was an amazing predictor.
Interesting. But we do have long bond assumptions for treasuries, corporates, and like a government credit, because a lot of our corporate clients have duration matching that they're using. So they're, and we also have like a treasury strip index that's got a 20-year duration too.
My second question was on page 4, actually, on the incorporating the potential impacts of kind of on cash flows. I think in particular, how do you all kind of incorporate? Is it more kind of a qualitative, kind of talking to the actuary, or is it you put in corridors on, essentially putting corridors around, let's say a maximum drawdown that would kind of increase the amount that would have to be contributed by the city. I was just wondering how is that kind of incorporated into your assumptions?
So we would use all the cash flow projections from the actuary, and then we can take those into our system and model them just like the actuary models them. But you can stress test them, right? And a good way to do that, we do it in really 2 contexts. One is looking at the variability of the outcome around the expected return. and seeing how that would affect the projected funded status, right? If the actuary tells you and they model that you're going to get 7%, and that in 20 years the funded status of the plan is going to improve to, let's say, 75%. We can model whether, if we don't earn the 7, what the kind of variability around the return would drive the variability on funded status. The other thing that we can do is, when we do a liquidity study, is if the city of New York is scheduled, let's say they're scheduled to put $1 billion into this fund, over some time horizon, 5, 6, 7 years out. And we're relying on that to make all the benefit cash flows, and we're tying that into the private equity pacing and the real estate pacing that Stepstone and Townsend and Cortland are doing. If, for whatever reason, we hit a market patch where the market is down, the economy's not doing well, right? So our return assumption, we're underperforming that 7%. And the city has fiscal difficulty, and instead of giving us $1 billion in 2020, they can only give us $800 million. What does that do to our cash flow for that kind of time period you look at? We typically try to look at like a 5-year time period. But it's like stress testing both your market assumptions and your liquidity assumptions. And remember, the biggest source of liquidity is the money that's withheld from the participants' paychecks, right, and the money that the city contributes. And if the city contributes, if their contribution is variable, I don't see it as big a problem. But we work with the city of Chicago, and the city of Chicago is like a poster child for why you would do this. And I don't work with the city myself, one of my colleagues does, but I work with one of the state of Illinois plans, and they're supposed to get $1.5 billion a year into the fund, and some years they get $700 million. So that has a huge. Well, it's funny because they're supposed to get $1.5 billion coming from the state, and they roughly have $1.5 billion going out the door, and it's a $17 billion plan. So if you have that $1.5 billion going out the door, right? Let's call it $110-15 million a month, and the state says to you, "We're only going to give you half." That money is got to that another $700 or $800 million is going to come out of your asset pool. Well, if you've got a 10% target to private equity and 10% in real estate, and you got to start siphoning off another $700 million on short notice, well, what's that going to do to your policy, your ability to implement your policy? All those things are important. It's complicated, but it's important to look at it on a regular basis. So I'll be quiet now because I think I've gone on a little long.
So, do you also model correlations? Because I didn't see them here.
Yeah, I didn't put the correlation numbers in here. We would regularly have them in here, and that's an important number, right? Because when we talk about your return assumptions breaking down, the correlation is the biggest driver of risk when you're intermingling different asset classes together. And if you have a period of time where there's an equity market sell-off, and as we did in 2008, and high yield bonds sell off, credit sells off, so some bonds sell off at the same time as equities. Those are typically times where you look at your correlation number and be like, wow, that number we used for a 5 to 7 year cycle really broke down in this 1 year or this 2 year period. And that's where you have kind of negative outcomes. And those are things that are important to examine. The correlations are really difficult. When you look at them just between stocks and bonds. You can look at rolling 10-year correlations, 3-year, whatever. The numbers move around a lot.
And John, I can also tell you, when we did the last asset allocation in 2011, and Doug will remember, we went over, because a lot of times you have the grids, and they look very complex, and there's lots of numbers, but they're very important.
They are.
A small move in correlations can have a big difference in what you ultimately look at. And we looked at these very carefully with all the consultants.
Yeah, and the city of Newark's in a good position because you've got data coming to you from at least 4 of the consulting firms that have their own assumptions. I mean, what we think is important is to have a process and to follow that process, make adjustments as necessary. But we also look at how reasonable our numbers are based on the buy side asset management firms like J.P. Morgan, Goldman Sachs, Wellington all have their asset class assumptions because they have asset allocation groups, and then we look at our competitors, because most of that stuff's on the web. It's publicly available to anyone who's who's got a public pension fund client. It's usually out there.
Okay, thanks very much, Doug. Very informative. We are now at the end of our public session for the pension funds and ready to move into the public session for the variable supplemental funds.
So we need a motion to that effect. But keep on the camera because it's still the public session.
Motion to move into the public session for the firefighters variable supplement fund.
And close for now the fire department pension fund meeting. Right?
Yes.
Okay.
Second.
Any objections? Hearing none, the motion carries.